Hey guys, I've got a major update for you guys. This is going to be a bit of a longer video, but it's going to go over a lot. We're going to talk about the current market conditions and where things could go for small cap Canadian stocks. We're going to talk about my growth stock portfolio. I'll show you all my holdings and my current thoughts on that. We're also going to talk a bit more in depth about two stocks in my portfolio, and these are Lightspeed and Borrowell Technologies, so you'll be able to hear my thoughts on these companies later on in the video. But before we get started, a word from today's sponsor. Doug Patterson is a mortgage agent who reached out to me trying to help Canadians, especially those who are first-time home buyers, secure financing for their first property. If you guys have taken out money from your stock market portfolio or just taken profits or have some cash sitting on the sidelines looking to invest in real estate or buy your first home, you should totally check out the app that he has. The app offers many different tools like a simple mortgage calculator, a pre-qualification tool, a stress test calculator, interest rates from various institutions, closing cost calculator, as well as a land transfer tax calculator. This app is completely free to use and you can take it to all your house showings and just do quick calculations on the fly. You can even contact Doug through the app and it'll get back to you in a very timely manner. First off, looking at some of the data behind the markets and where things are going in the future. I pulled up a heat map here of the S&P 500 and just showing you different views of it. We've got the 1 month performance, the 3-month performance, and the 1 year performance. If we compare the performance a year ago to today, most of the market is up and fairly significantly. However, the 3-month and the 1 month story don't look as rosy as the 1 year story. So in the past couple of months, the stock market has taken a turn for the worst. And there's various reasons behind this, and honestly, it's just people speculating. Because in the short term, the stock market is a voting machine. In the long term, the underlying metrics of the businesses is what matters. I've also got a chart here showing the S&P 500, it's down about 10%. And if we look at the fear and greed index, currently we're sitting at a 33, meaning that many investors are fearful. And the great Warren Buffett has always said, be greedy when others are fearful. So right now I'm actually looking critically at the market, trying to figure out when to deploy cash. I think it's not wise to deploy all the cash I have as the market is falling like a knife, but it's better to wait for the dust to settle. However, those of you guys who just got into the market about 2 years ago when the pandemic hit, you'll notice there was a very steep drop in the market in March and then a very sharp rebound. This is not typical behavior of the stock market, and I don't expect that going forwards for this current crash. I think that we could probably see a longer term lull where we see the market fall fairly significantly and drastically, and then we're going to hit some sort of bottom and stay there for a little while before coming out again. Now looking at this chart of the S&P 500 zoomed out a little bit more, we can see that it's dropped below its 200-day moving average, as well as its 50-day and 100-day moving average. So I think it's safe to say that we're starting to enter bear market territory. So this morning I was reading an article where it said Microsoft took 16 years to return to its 1999 all-time highs. He was suggesting that right now we're in the bust phase of a technology bubble and that it could take a long time before stocks recover. But I think if we look at the P ratio of the S&P 500, just let this sit with you guys. In 2000, the P ratio was around 43. But today, the P ratio sits around 24. And at the peak during the middle of COVID-19, we saw the P ratio hit 37. But we're already significantly down from that at 24.5, which is on the high side, but not super unreasonable. If we look at the dot-com bubble and some of the companies that were sky high back then, a lot of these companies didn't even have revenue. All they had was a website. However, today, a lot of the growth stocks that we own, they're revenue-generating companies, but they're not profitable. So they're one step ahead of the dot-com bubble stocks. I wouldn't say they're as bad, and therefore I would like to believe that we're not in as a speculative position as we were back in the dot-com bubble. Another thing to note here is also consumer spending in the US is at an all-time high. We only saw it drop during the pandemic, and it's crazy how we've already recovered from that, even though I think the unemployment rate has not yet reached its pre-pandemic highs. Consumers are still spending, so I don't think that we're in a risk of recession where people are going to cut back on their spending just yet. And right now, you guys have to realize that Wall Street is playing the narrative in the media. Just a couple months ago or half a year ago, people didn't really care about profitability. And it's a little bewildering why they didn't care about profitability. All they were caring about was growth. I mean, I think growth at the end of the day is great, but if there is no profitability that can be found in these growth stocks in the future, then that's definitely a clear red flag. But I think a lot of these companies, growth stocks alike, they raised a lot of capital and they're going to be able to fund their way through this little dry spell period that we're going through right now. where their stock performance isn't doing as well, and therefore they can't raise cash on favorable terms. But at the same time, if we zoom out and just kind of try to figure out who's the players in the market, well, the major players are these big funds. And these big fund managers, how do they get paid? They get paid regardless, but they get paid a bit more if their fund kind of matches what the market does. And if they can outperform the market, then obviously they get the biggest bonus. And right now, with bear market territory, these fund managers, of course, are short-term looking, and they're looking at 1-year performance. So as a fund manager, you don't want to be the guy bag holding stocks. So of course, if the narrative is going negative, you're going to sell out of all your growth positions because you don't want to be the laughing stock on Wall Street holding those growth stocks. But the superpower that you and I have as retail investors is that we don't care about this. We can choose to invest for 3 years. We can choose to invest for 3 months, or we could choose to invest for 30 years. So if you're like me, someone who's willing to hold for 20 to 40 or even 60 years onto these investments, then you can invest confidently into these companies because you're not playing the same game as Wall Street here. You don't care about short-term profitability. You care more about long-term growth in these companies making products that people want. Now, at the end of the day, in business, if you don't have a product that people want, then you're not going to sell anything. But if that product brings more value than the cost of it to its customers, and that company has a moat around that product, then that company has hit the gold mine. With that said, let's jump over to my computer and talk about my growth stock portfolio. You guys can finally see what's going on in there. So guys, this is my Wealthsimple portfolio, the growth stock portfolio, currently sitting at just under 30,000. If we look at the wild ride that it's had, at all-time highs we were around 47,000, and right now we've dropped down by about 17,000 or so. So this is crazy, but you know, this is the name of the game when you're investing in growth stocks. Everything that's high risk, there's high risk but possibly a high reward. But at the end of the day, my mentality for this portfolio is to hold these stocks long term. I'm willing to hold for 10, 20, 30, even 40 years, and I don't need this money tomorrow. Ultimately, these investments can be held to retirement. So just scrolling through the portfolio, you can see all my positions and my all-time returns. Some of these stocks I'm down 70% on, which is crazy to think. And some of these stocks I'm still up by about 10%, 12%, 73%, 38%. So it's not all doom and gloom. It just really depends on what I got into the stock. At the same time, I think going forwards, it's like, what do I want to put my money into? Because some of these stocks that have dropped significantly, there could actually be value there that I think that going forwards in the future, this business will be better in the long term. And I would say that with most of the companies that I hold in this portfolio, I think that there is a shot that they can become better in the future. I'm not saying all these companies will succeed, but honestly, the mentality that I have with this portfolio is kind of like a VC fund, where I know that some of these companies possibly will just completely fail and enter penny stock territory or even just go bust, but some of these stocks could be 10 baggers. At the end of the day, nobody actually knows where the stock market will go and where individual stocks will go. And I think the best thing that you can do as an investor is just arm yourself with education and knowledge and try to make your best well-informed decision based on the knowledge that you have. And if your investments go bust, then at least you've learned something from that investment. But if you invest blindly into companies because someone said so, then at the end of the day, I think that's the person who's the biggest loser because you don't learn anything and you've lost money. Now I'm just going to highlight a couple stocks for you guys and my thoughts of them, and these stocks are Wellhead Technologies and Lightspeed. So for those of you who are curious about my thoughts on Lightspeed, because I did cover them after the short report, we're just going to quickly go over some key facts from their latest earnings call. First off, there was an executive leadership change, where Dax De Silva, the founder, became the new executive chair, and he relinquished a position of CEO to Jean P. Chauvet. And JP is not new to Lightspeed, as he's joined Lightspeed in 2012 as its Chief Revenue Officer. So he has at least 9 years of history with his company already, and now he's going to be taking over the CEO role, and Dax De Silva is not leaving either. He's the executive chair focusing on other aspects of the business. So under new leadership changes, we must know the goal of this new CEO. And first things first, he thinks it's very important to stress that Lightspeed is a software company first and foremost. Payments is an important part of the revenue stream. However, payments is there to enhance the value of their core software offerings, not to replace it. Ultimately, the software is what's going to attract people to user systems because it's going to make customers' businesses more efficient. Payments is like an additional cherry on top of the cake. When they sell their software, they can probably ding down a few percentage points on the payments aspect to make it actually cheaper for customers to use Lightspeed payments versus third-party offerings. In this way, they still capture revenue from payments, not as much as a third party would. However, they are capturing revenue off the software, which is their first and foremost intent. But at the end of the day, we as investors care about money hitting the bank. So what does growth look like? So JP believes that the company can grow 35 to 40% organically each year. You guys might be looking at this number 35 to 40% as very low, because if we go over to Lightspeed's revenue growth over the past year, you can see they put up triple digits in the past 4 quarters alone. Well, just to tell you guys, these 4 quarters were inflated because they made major acquisitions that practically doubled their revenue. So these revenue growth numbers are not organic. This is including acquisitions, which is a major part of the revenue growth. So 35 to 40% organic growth each year, that's a fairly high target in my opinion. And if they can hit that, I would be happy as an investor right now. Now he also hints at a new possible business opportunity with Lightspeed, where there could be more streams of revenue coming in through the contribution of their supplier network initiative. I don't really know what this is right off the bat, but this is possibly working with suppliers, maybe helping with supply chain things, making shipping cheaper, getting bulk rates for their customers. And this is something that we see Shopify doing right now. Shopify is trying to help small businesses get connected to suppliers as well as shipping and logistics companies to make everything a lot cheaper for small businesses so that they can be more profitable. If you know more about the Supplier Network Initiative, let me know in the comments down below. The last thing that I want to highlight here is that JP wants to ensure investors that reaching profitability remains a priority. There will be more clarity on that front in the coming quarters. So right now, I think investors are a little bit in the dark about profitability behind Lightspeed. And right now you can see the market shifting more towards companies that are profitable. So if you're unsure about Lightspeed because of their profitability, perhaps just keep up with the company over the coming quarters and see what the CEO has to say on profitability and when they'll reach that. But if you're an investor who likes to take risks, Lightspeed could be an interesting investment for you because right now they don't really have a plan to profitability that's been released. So before that news comes out, there's still a lot of uncertainty about the company. And the stock continues to sell off, and this is where you could get in at a reasonable or cheap price compared to where it could be going based on news that comes down later on the road. However, there's still great risk involved, which is why the stock continues to sell off, where investors don't have the confidence in the company going forwards in the future. And we can see that with the current market sentiment. Now, I've got a few things that I want to mention about Well Health Technologies, and I know that I haven't been making as many videos on this company. And that's just because of the nature of the stock market, and honestly, there isn't too much to report. If you look at 2022 so far, they don't have much news on their website. On top of that, we know that investors are moving away from small cap stocks, so there's less hype around the company, and I think the company right now is just kind of focused on executing. Going over to Yahoo Finance though, looking at some of their basic metrics. Looking at their current assets versus current liabilities, right now it's about a 1-to-1. That could be a little bit scary for investors. However, looking at their cash flow, this is where things get a lot better. If we go to the quarterly cash flow, we can see in the past 3 quarters, they've had positive free cash flow. And this means that the company is taking in more cash than they're actually putting out. So this is very good for the balance sheet because they can still maintain a 1-to-1 current assets to current liabilities with a positive cash flow, albeit a little bit small, but at least that will continue to fuel the business and they have enough to continue to live another day, another year, and probably another 5 or so. I think Well Health made a very smart move with acquiring CRH, which is a cash flow machine, at least for the size of business that Well Health Technologies is. So overall, to me, Well Health Technologies, in the short term, there probably won't be too much action in the stock, but in the long term, I think they're building a business that's going to be better in the future than it is today. They're essentially consolidating the healthcare network to make it more impactful as well as more efficient for Canadians. If you guys enjoyed this longer form update on the Canadian stock market and just my thoughts, then be sure to subscribe down below for more content on the Canadian markets and my portfolio. I've got a couple videos up on the screen if you guys are interested in those. I'll see you there. If not, keep up the grind and have a great day.